Hello everyone, this November 2022 podcast is focused on floating rate bonds indexed on the short part of the interest rate curve. Traditionally, these instruments were popular as a hedge against rising interest rates. By investing on these instruments, investors could focus their attention on changes in credit quality of the issuer without worrying too much about the interest rate changes to come. With interest rates held low from 2008 through to 2021, many issuers preferred to lock in their interest rate liability on fixed coupon instruments rather than floaters to avoid exposing themselves to any future interest rate risk. The result of this has been a limited quantity of floating rate bonds coming to the market. A constrained supply of floaters has meant the spread premium for these bonds was low, making them an unattractive investment. In sum, floating rate instruments have not been very popular for both issuers and investors up until now. With interest rates on the rise, the appetite for these instruments has regained momentum, notably with investors. Yet their supply remains limited. As a result, these bonds are comparatively expensive when compared to non-floater bonds. We would like to draw the investor attention to a niche in the fixed income world, the subordinated floating rate instrument. Subordinated instruments are not classic bonds. Because of their status, these instruments offer a premium. With high short-term interest rates, this premium is translating into interest rate returns between 6.5% and 9% for this kind of instrument. This is not accounting for the rising yield potential on these floaters, which will increase as the level of interest rate rises. For the issuers of these bonds, this capital resource is becoming increasingly expensive. Therefore, there's an incentive for them to reimburse the instrument when this is possible. In such a scenario, when these instruments are trading sometimes under par, this offers the investors the opportunity of an additional capital gain on top of the high carried yield when the bond is called. So to recap, subordinated floaters are an investment worth considering an allocation to for the high carried yield they provide, the scarcity of these instruments making them a very desired investment at the present time, for the protection against rising interest rates, and for the capital gain potential on discounted bonds. A reminder before closing this podcast, floaters could become less attractive if short-term interest rates were to fall dramatically. When allocating to these instruments, we would suggest investors focus on financially sound issuers only to limit the exposure to credit risk. This podcast is for information only and does not seek to provide any investment advice. Investors should seek specialist guidance when investing in this asset class. Thank you for listening.